cryptocurrencies have suffered greatly lately. For example, the US dollar and Bitcoin exchange rate fell from around $70,000 in early November 2021 to less than $20,000 in late June. Despite fluctuations, the rate fell to $19,733 on September 15. The most well-known cryptocurrency, Bitcoin, has historically yielded profits for investors. 5 years ago, its value was less than $3,000 per dollar. But there are two areas where a lot of people who embrace Bitcoin have been disappointed. This cryptocurrency has shown to be a poor way to safeguard one's buying power against volatility and inflation, since it has not taken off as a popular method of payment. It's unexpected this. There are 21 million Bitcoins in circulation. Given that over 19 million, or 90% of the shares, had already been issued, most people expected the cap to result in an ongoing rise in the dollar value of the stock. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. What is the future? To foresee future cryptocurrency circumstances, it might be useful to consider what occurred in the past and clarify a few key points. First of all, the blockchain ecosystem is made up of cryptocurrencies and their derivatives. For example, Bitcoin is a cryptocurrency, but Tether and Terra USD, two stablecoins, are cryptocurrency derivatives. These are derived from cryptocurrency or linked to a widely used, centralized money, such as the dollar. Put simply, a firm receives funding from a financial investor in return for a derivative. The company converts the cash into bitcoins before lending it to clients abroad. The firm promises to the financial investor that it will swap a specific quantity of a cryptocurrency, maybe backed by dollars or indexed to the dollar, for the derivatives upon demand. As a consequence, if you have invested in bitcoins or other cryptocurrencies, your portfolio's exchange rate will determine whether you gain or lose money. But if you've already bought a derivative, you may find that, to put it bluntly, the dollar convertibility guarantee is porous or that the derivative isn't really backed by enough cryptocurrencies. In this scenario, the derivative becomes almost meaningless. This has been the case in recent months with many Bitcoin derivatives. Companies that issue these instruments are extremely active in the market and contribute to the volatility of the underlying assets, especially if they provide amazing profits that drive demand for cryptocurrencies and crypto derivatives. If the derivatives products are not sufficiently collateralized during challenging economic times, investors will run. Another crucial point is that instead of being used as a means of payment for everyday transactions, cryptocurrencies are now seen as a store of wealth and a speculative tool. Just over 250,000 bitcoins were moved per day as of late July 2022, and it's probable that very few of those deals were made for business reasons. For example, accounts holding more than 100 bitcoins apiece have over 60% of all the bitcoins in circulation and are seldom exchanged on the market. Additionally, it seems that cryptocurrency owners think long-term. For example, as a consequence of the present sell-off, shrimps and whales have both purchased the dip in large proportions. The long-term outlook of the average cryptocurrency holder indicates that the project will withstand significant volatility and is not easily destroyed. Second, the volatility has been exacerbated by cryptocurrency derivatives, whose activity has been amplified by the comparatively small amount of cryptocurrencies traded on the market. And third, the derivatives industry has been impacted by and may have been eliminated by the 2022 cryptocurrency market crash. Based on nothing, but worth something. Naturally, cryptocurrencies differ from stocks and bonds, which are backed by assurances of future revenue streams, sometimes provided by a government promise to squeeze taxpayers, and sometimes produced by a company's excellent market performance. Rather, cryptocurrencies are units of money that are not backed by anything. Their value will only rise when they are accepted as a valid form of payment for future purchases of goods, services, and other services. Central bankers and officials in general caution the public about cryptocurrency scams at any chance they get. The European Central Bank's president, Christine Lagarde, has said that regulations are required to prevent inexperienced investors from losing all of their money invested in cryptocurrencies as they are worth nothing, and based on nothing. It is ironic that central banks provide digital currencies, which President Lagarde considers to be vastly different from cryptocurrencies. Central bank-issued digital currencies are different from blockchain-based cryptocurrencies, but not for the reason Ms. Lagarde probably believes. The primary issue is that supply-limited, decentralized currencies would completely eliminate the idea of monetary policy and replace central banks with entities that oversee commercial banking and provide data. It seems sense that the central banking world has not been very thrilled by the possibility. Put another way, central bankers do not resist cryptocurrencies even if they are allegedly untrue. If being based on nothing equates to fraud, then central bankers need to face legal action. Rather, their animosity stems from their conviction that a widespread acceptance of cryptocurrencies will ultimately jeopardize the advantages of central banking, potentially affecting aspects like as the financing of public debt. Scenarios. Policymakers and central bankers have three possibilities. Number 1. Ignore. They could ignore, prohibit, or exert control on cryptocurrency. The easiest action is the first one. Why should central bankers care? Ultimately, the Bitcoin market is very competitive, and some coins will disappear. Moreover, they don't truly represent a financial risk at this time. Because there is still a substantial fee associated with each transaction, moving from dollars or euros to one or more cryptocurrencies may be challenging. As long as governments accept centralized currencies like dollars and euros as the sole means of payment, switching to cryptocurrencies would essentially be the same as adopting an inconvenient double currency system, which many would find objectionable. There have been these regimes in the past, although briefly. Number 2. Outlaw. A cryptocurrency prohibition would be meaningless unless the government was worried that large-scale cryptocurrency transactions may lead to unstable fiat currency exchange rates. In addition, a worldwide campaign is required to outlaw Bitcoin. If any countries decline to proceed, its legitimacy would be damaged. The main problem with this approach is that purchasing futures in cryptocurrencies is legal, and it is not evident at all that individuals who do so are acting against the interests of society as a whole. Number 3. Regulate. In the end, regulation seems to be the safest course of action. Since there is no credible short-term danger to fiat money as a medium of exchange or evidence of its use in money laundering, the authorities' only actual worry is taxes. It is probable that the regulator will focus on this specific problem. The tax collector has no means of knowing how much money the taxpayer has hidden away, and it would be very difficult to even establish if a person has an account. This is mostly unrelated to the decentralized structure of cryptocurrencies. Future regulations will concentrate on making more transparency mandatory in order to track and tax this kind of wealth. In early July, the European Parliament adopted the Market in Crypto Assets proposal. Crypto asset suppliers won't be able to operate their companies without authorization if this technology is widely embraced. There will undoubtedly be constraints linked to this license to safeguard investors from fraud. In practice, these criteria will compel investors to make their accounts public. This is only the beginning, until technology makes authorized dealers unnecessary. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.